And welcome to From the Research Chair. This is episode number 24. It's our 1-year anniversary. And for the record, this is our first one together in person. And Michael only about 15 minutes ago learned that I was even in Chicago to co-host this with him. It was a big surprise. Yes, Alam, exactly right. And thank you for the 1-year anniversary. Today's topic is finance industry rants, curmudgeonly rants to be specific. What's your first one?
Rants from the research chair. Folks, I was aspiring to be a glorious curmudgeon when I got older. So I have to start early because I don't know how much older I'm actually going to become. Let's start with the amount of jargon our industry uses. Can I just start with that? Oh my God, we have complicated the language in order to extract fees from our clients, the people we are trying to help. Can I just start there?
I'm in total agreement. I'm still trying to master some of the jargon in the business, and this is almost my 30th year. Like almost every 2 or 3 months, there's a new thing. SPAC being the most recent example.
SPACs. Give me your money. I'm not going to tell you what I'm going to do with it. Oh, and if I actually do anything with it that's successful, I'm going to take out a few pounds of flesh before you can ever earn a rate of return. Oh, and by the way, I have no track record of success doing this. But trust me, and please give me your money.
It is utterly bizarre. And if ever there need to be proof of, next rant, too much capital Federal Reserve, too much capital ECB. It's the idea that a SPAC could get funded in the first place, but everybody's so desperate for a return because there isn't any, because capital isn't scarce.
No, capital is plentiful. You know, normally we would applaud that and say, wonderful. A lot of people have a lot of money. Now, we won't talk about the density of where the money is. Now, how about that for jargon? That simply means too few people have much of that money. But let's put that aside right now. How about when there's too much capital, rates of return get lowered because you don't have to supply return when there's that much capital chasing it. Simple supply and demand. So oversupply dampens demand.
So the irony, and I'm not sure how strong a rant this is for me, but in capitalism, we treat capital as scarce. If it's not, is it still capitalism? Question.
Ooh, that's
next question is, you know what is scarce is labor and land. But we don't maximize that. That's not the denominator of any economic system.
Labor's not scarce. People just don't want to work. Bam. Come on, folks. I'm not saying everybody can do every job, but the concept of a job, please. I'm good enough. I'm nice enough. I'm smart enough. I'll show up on time. So you ought to give me a job. You know what that's called? That's called an entitlement. No. Everyone, most everyone, I want to be careful here. Most everyone is capable of some level of work. Just do work, folks.
Well, then here comes my next rant. All too often, because labor is not treated especially well at most organizations. I had my job at Burger King when I was a teenager, not treated especially well and not working with great people. And what's my incentive exactly, other than my $3.35 per hour I made back in the day? Not much. So here's the next rant. Treat people better. Nicely, exactly. Yeah, and businesses are getting better, in my opinion, at that.
Businesses are getting better. Wow. Right. Listen, you need people to work for you. You need to entice them. And that can be capital, money, pay them a better wage. That is an extrinsic reward. How about the intrinsic rewards? How about a decent culture in your workplace? Appreciate them, no matter who they are, no matter what they look like, no matter where they come from. Just appreciate them, because you know what? They're helping you make money because they're working for you.
Mastery, autonomy, purpose. We say it at Focus Consulting Group pretty frequently. So much more important. What's the number? Like after $70,000 in US
$75,000.
$75,000 US, your motivation. All of a sudden it's not one for one. I don't know what the curve tilts, like the
Curve
slope.
tilts. And it's geographically impacted. 75,000 in the middle of the plains of the US
More
is a lot more than 75,000 in the middle of New York City.
Well, no fooling.
But then again, nobody's in the middle of New York City anymore because of COVID. They all vacated.
I was just there not too long ago. It's coming back.
Oh, there's few people
It's
left.
coming back. Yeah, there are a few people. Restaurants are open. Yeah,
That's optimistic.
yeah. Chicago actually has more maskage than does NYC at this moment.
Well, that's because of the robberies.
Yeah. Okay. Wasn't banditos? So I was referring to, my
that's
friend.
correct.
Right. So my first rant is, and you've heard it before if you're a loyal follower of the podcast, I hate the style box. I think the style box is anti-human. It turned our business into one of return or benchmark return chasers. And nobody was born a mid-cap core manager. I'm sorry. That's not even a legitimate distinction. Like, I either find good businesses in a fundamental way and know how to price that and buy that, or I'm a momentum investor or something, but nobody's born a mid-cap core manager.
One of the most famous quotes from a movie from my teen years: nobody puts baby in a corner. Do you know the movie?
No.
Oh, Ed, tell everybody what that movie is, because they unmute Ed, tell people the movie. Come on. Dirty dancing. No, so if nobody puts baby in a quarter, why should we put any investment manager in a box?
Yeah,
we should be nicer to the investment managers the same way we were claiming to be nicer to baby.
Well, we've explained this before on the podcast, but in case you haven't seen that episode, our problem with the style box is that it and Fama and French's confession that the strong market hypothesis, strong version of the efficient market hypothesis, had a hole in it. Namely, in 92, they said there's a small cap effect and there's also a valuation effect. And then lo and behold, 2 months later, Morningstar, also here in Chicago, then said, oh, let's explain excess returns this way, since the gurus of this movement have acknowledged that this is how you add excess returns. Meanwhile, hundreds of anomalies in the market have been revealed. And so it's no longer explanatory of how you might add alpha. And not only that, but it's no longer an after the fact evaluation. It's become a before the fact navigational compass point. And that's the issue I have with it is if we're really good at identifying high quality businesses and high quality management teams, why would we care about the cap size? Why would we care about whether?
I don't think we should.
Yeah, I don't think we should either.
Do we really care if we're making money where it comes from, as long as it's legal?
Yeah, no, we don't. And by the way, tracking error and style drift and all those other measures, that's my curmudgeonly first rant.
Well, that's jargon for the consultants to extract their pound of flesh.
Oh, next rant. Do the consultants and their contribution to the investment process, are they evaluated the same way the investment managers are? Do we know that they're adding value?
No, actually, we do know they're not. Research has indicated that the consultants are no better at picking managers than people.
Well, that's true. I have seen that data, but they're also extracting their little pound of flesh along the way.
They are. So I'm going to go for my next rant, and it's printed on my T-shirt. Master of strategery.
I don't know what that means. You have to explain.
Well, it is the wrong pronunciation and understanding of the word strategy. So it's perfect for almost our entire investment industry. Our entire investment industry, let's just say, is not good at strategy. The innovation is missing.
Oh,
strategy. Sure. It's not a 50, 100, 200-page document that comes from an overly expensive consulting firm. No, it should be 3 to 4 pages that is operationalized, meaning the rest of your organization has given you input into what should be underneath the strategies that you think will help you win in the future, how they're going to help you execute. If you don't bring the people that are working for you along, They will not come with you. You will not be able to execute whatever that strategy is. And as a result, you are doing strategery. You think you are doing something, but you're actually doing nothing.
So is the end of strategery, is that buggery? I mean, so we have some people in the UK. That's a tough word, but like, is that what's happening there?
To a large extent, listen, you're not coming down from the mount with 10 commandments telling your people what to do. No, if your people are neck deep in the work, you want to ask them, how are we going to revolutionize or evolve what we're doing? You need their input. Let them participate and call out where you're going to go. And by the way, innovation does not mean doing the exact same thing next.
Oh, preservation of AUM? That's not innovation? Anyway,
No.
So you raise a great point about innovation. Oh, and by the way, I have to say, bye, Karen. Nice that you came. Come again. This we marketed this as, if you have rants, please feel free to take the mic over. This is not meant to be an educational session. This is sort of like a gut spilling. This is meant to be over, depending on your time zone, over cocktails or tea or whatever your preferred beverage is. The rants that we all have among our colleagues, the things that bug us that maybe we don't have a safe place to necessarily express.
Can I quickly, one more rant?
Yes, of course.
Pitch books.
Well, don't go to a pitch book yet, because I was going to hit innovation note.
Oh, okay, go ahead.
Yeah. So the innovation note, I gave a presentation to a largish, how to characterize it, Pennsylvania bank. I won't say who. And it was a group of their largest producers in the private wealth sphere. And I called them out. I said, can you name a great financial innovation? And basically the one that came up with was an ATM machine. And this was like
Paul Volcker. Was Paul present? Because that's a quote from Paul Volcker.
He was not, but it was like 4 years ago. And that was the only one that they could really universally agree to had been an innovation. And they said, well, regulation limits the amount of innovation we can do. And I said, what about this guy right here? This guy is so cool and underused by our business. And I proposed the following hypothetical. I said, financial statements are the number one request I ever get from people, other than what should I invest in? It's like, can you explain this to me?
They can't read it.
They can't read it. Nobody can read it. Even the pros have a hard time reading these financial statements and extracting real meaning. They're meant to be the check-in based on your financial goals. What about a dynamic financial statement that is customized to the person's individual experience and their individual goals? And it says, here's how you're tracking relative to this goal, not just a pile of money. Oh, and I can't even change the color of the financial statement. I can't even change the font. Oh, but then location-based services interlinked with credit card information and Samsung Pay and Apple Pay and all that. I could track in real time how you're really doing with your monthly budget. So you purchase like a really nice sport coat at something and you get a notice, enjoy the sport coat, Jason. We hope you do, but it sets you back on your financial plan by about 2% so far. And you don't have to do it. You could elect not to. You have an Apple Watch. I don't, but that Apple Watch could track your heart rate. So it could also then look at when you open up your Schwab account or your whatever account, and they see that your heart quickens, and then that triggers a call from your broker, and the broker says, hey, look, I know the market's down 500 points today. I just wanted to check in with you. These are innovations.
Real-time interactive. Jason knows this storyline because we have spoken about this. I know Ed knows this storyline because we have spoken about it. Think about a real-time line that is moving forward towards the smiley face representing your goals, whatever they are. And now 1 step forward, 2 steps back, 1 step forward, 2, based upon what your real behavior is: spending or savings, buying or selling, trading. No, we don't. No, trading. Well, that could be a rant, but I gotta go to pitch books.
Oh, one last thing on innovation.
Okay.
I'm going to say it. I've said it before. Our whole industry, this is somewhat related, is got one conversation it dares to have with our customer. And that's the R word, retirement. Yet having retired back at 35 and then re-entered the workforce in an elective fashion, I can tell you that retirement is taught by all of our profession to customers by people who've never gone through the event themselves. So there's a dislocation there. They haven't actually experienced it. And the biggest issue was not finances. Yeah, there was some nervousness there. It's things like identity issues. It's around how much can I spend, not spend. And yet that's the only conversation we have. Say you retire around, say, 55 to 75, some range therein. There's so many intervening financial moments. Talk about innovation. What about monthly budgets? What about, and by Ed, I saw your comment about the somewhat creepy with the jackets. Well, it could be opt-in, right? I know that I have trouble with my monthly budget. I actually need those check-ins because every once in a while I do retail therapy or whatever. My point being, there's so many conversations we could have with our customers. We only dare one. Why? Because that then allows us, conclusion of the rant, to say you should be a long-term investor. Don't do turnover. Stay with us. Even if our performance sucks, it'll eventually come back around, et cetera, et cetera. Retirement is a great conversation for our business, but for customers, it's this abstract thing that's decades into the future on average. Rant finished.
Well, just for giggles, right? People know I'm a CFA. You're a CFA. I'm also a CRC. People don't have a clue. With certified retirement counselor. Oh, the things that I know about retirement. Wow. It's Jason's comment about identity, huge. Personal relationships, huge. Retirement ranks up in the psychological literature as a stressor that is just a couple of steps behind divorce. Because it's divorce from your career, your livelihood. All right, pitch books. Oh my God. Investment managers out there. Really? Do you really not know why people hire you? They hire you for your performance. So first and foremost, show your performance. And if you're afraid of showing that, then you can't pitch because nobody wants you. So show your performance. Now, if you can validate that you're good enough, now you have to show them how you obtain that performance. Talk about your investment processes for people who are not in the US. And when you tell the story about how you did it, that adds believability or doubt. Now, after you've validated you're good enough to be hired, and you have validated you should trust us because we do actually know what we're doing. Now, you can talk about anything else you wish. But until you clear those first two topics, nobody should hire you. You start off telling the story, we've got a whole bunch of smart people. Yeah, because most investment teams are filled with dumbasses. Come on, really? Oh, and we've got wonderful investment process. I don't want you to tell me about it. I want you to validate how it works.
And may I insert here? Really? When's the last time you and I heard in our work together a unique investment process we hadn't heard before?
Never.
Never.
So maybe it's not as much about unique. Maybe it is about doing it well. Maybe it's about the execution. How about a proof statement? We've been doing this for 10 years. Here are our numbers. Here's our batting average. Here's our slugging percentage. We actually, of every security we invest in, we get 55% of them right. And our average slugging percentage, data that supports how are you earning your returns. I'm not a performance pig, but let's be candid. If you can't perform, you shouldn't get my money.
You left out one thing, and I'm surprised. One of our pet peeves is organizations who don't state what job they're trying to do up front. Said another way, a mushy, foggy, smoky investment philosophy. What is it you're trying to actually achieve and do? And I'm sorry, the style box is a handy crutch, but again, you're not a large cap value manager. That's not really an investment philosophy. Again, that's a descriptor after the fact of the things you tended to invest in.
Old stodgy companies that didn't make money?
Old stodgy companies that didn't make money. We got Ed.
Oh, all right. Jason, I've I'm feeling a little ranty. Jason has one more if he wants, or we get to open it up for audience participation rants.
Well, I do have one rant, and that
Okay.
relative and related to the pitch deck. The closet indexing business, the asset under management agglomerators, but go away, please.
Are you suggesting they come out of the closet and leave?
I'm saying they come out of the closet and acknowledge that they're index funds and just say, hey, we're converting to an ETF. We've secretly been an ETF and desired to be an ETF for the long time. I'm sorry, research analysts, you're going to have to re-educate as private wealth managers, but we are confident that you're going to be better than some of the private wealth folks that are out there. Sorry, our special guest that's in the house that brought me here, et cetera, et cetera. But there's just too many active managers. Not everybody can do it well. Not everybody can hit a freaking fastball out of the park in baseball or with the cricket wicket actually get good runs, right? Not everybody's great at it. Yeah. And there are so many people who survive on through the brilliance and legerdemain of their marketing and their relationships with institutional investors and blah, blah, blah. How is any of this good for the client? Question mark.
Mind you, we actually like active management. We're not negative on active management. How's that for an anti-rant? We're just saying, if you're going to be an active manager,
be active,
bring it or go away.
All right. Audience rants, including rants about our podcast.
Oh, yeah, that's fair game.
Yeah.
Why not? Who would like to rant? Come on, I know you have it in you.
And if it isn't obvious and if you don't want to volunteer, we've got more.
Oh, yeah. Nobody?
Simon, I know you have a rant in you, and I don't know if it, because this is a somewhat public forum, but we exchanged a rant via email just last week or 2 weeks ago, right after our last podcast.
Don't be shy.
Well, that's kind of true. I mean, I guess it was a rant. It's more about, it's to do with active management and how the mindset of benchmarking, style boxes, pigeonholing, all that stuff, tracking error, constrains an active manager and has nothing to do with what an active manager does. So, I mean, it's kind of the same as your rant, really.
So share, though, your great line, though. You had two great lines in the presentation you shared with me afterwards about that to me just illustrate perfectly the issue.
So I think you're referring, first of all, to the benchmark itself, the use of the benchmark. So if you think of growth charts for babies, those are benchmarks too, complete with medians and quartiles and all the rest of it. And if your baby is too long in the leg, what do? Are you going to cut their legs down? Are you going to fire their parents? Like, it just doesn't make sense. I think that's one of them.
That was one of it's so brilliant because it's so true. It highlights in an instant like how ridiculous the measurement is.
Totally. Now, what was the other one you objected to?
Well, yeah, I won't put you on the spot. And
I mean, we had a few there, right?
Tracking error was for
robots. Tracking error was for robots. Something about
pigeonholing. Oh, yeah. That was it. Tracking error for robots.
Okay. So that doesn't work anymore. So back when I did that presentation, which was 20 years ago, if you Google tracking error, you got thousands and thousands of entries to do with robotics. Now, if you do it, it's all investment stuff. So it doesn't work anymore.
Exactly. So good rant. And thank you for sharing. Ed?
Tracking error. Once you're done, if you've performed exceptionally well, you have significant tracking error. Tracking error is not evil. It's a stupid measurement.
Well, and I think you and I may actually disagree on the following. Since we're on the benchmark topic, I had a conversation with somebody one time, and for those of you who don't know, I did pretty well as a PM, at like really well. And I was having a conversation with an academic, and he said, "Well, you clearly had the wrong benchmark." I'm like, "No, we chose our benchmark. Our fishing pond was made up of stocks in that benchmark, and I just happened to do really well." He's like, "No, you had the wrong benchmark." And I said, "Because I did well?" And he said, "Yeah, that's why." And I'm like, "That makes no sense." So next rant. Academics, what are you doing?
Oh, no, we just need to change one word, one letter in academics. Get rid of one of the E's and replace it with a U. Academics. Now, that was a Freudian slip by me at a conference I was speaking at in Virginia back in the dark ages to a room full of academics. Freudian slip. Oh my God, did the audience roar with laughter? So they get it. They get it. And they like it. They find it amusing. All right, who else has a little rant? Or are you putting them in the chat box because you're afraid?
Yeah. Okay. So let's open up.
Alam is nodding.
So let's open up. And by the way, I understand I gave a presentation in Boston at a thing called the Fund Management Forum. And I was sharing the stage with the Morningstar guy. And we were debating the merits of some of these topics we're discussing. And I turned to the audience at one point and I said, how many people here have a good relationship with their consultant? And everybody raised their hand. And I said, how many people have a bad relationship with their consultant? Nobody raised their hand. I said, how many people are terrified to answer honestly because their consultant is part of the audience? Nothing but laughter, roars of laughter for like 30 seconds of laughter. So we understand. We understand. We're
going to go that way. I gave a talk, FPA, Illinois, a few years ago. And I said, but hey, before we get into this, let me ask you a question. Don't answer. Just appreciate my question. And this was to a room full of financial planners. I said, if you could slip into your client's coffee a little Prozac before they came into your office, do you think you could do a better job for them? Oh, the expressions on they were trying to withhold their laughter. They were enjoying that question so much. I said, all right, second part of the question. If you took a Prozac before your client showed up, do you think you could do better for them? And then they just roared with laughter. Folks, can we just admit? All right, to the audience. What do we have, Jason? Anybody have a rant for us?
Alam, you chatted one in, hiring from the same university. You want to speak to that one?
Yeah, so basically, a lot of investment houses, they hire people from went to Russell universities or went to Harvard University or Yale University, and then they sit on the exact same committees and they just one massive echo chamber. Or also a lot of firms, they've been propping up their employees. So if they say the employees have certain qualification when they don't, then just when they're doing sales pitches, go, oh, my analyst has all these qualifications, and look at all the past performance when there's actually nothing there. So stuff like that really pisses me off.
This irritates us too, and I know Alam, you're one of our loyalist followers. We did mention that in passing in one of our podcasts, I think when we were talking about cognitive diversity, and I did a piece on it for CFA Institute where I looked at the education of all the people in the investment management business in the States, and it was something like 40% went to the same 5 universities. And contributing to bland sameness and results are closet indexers, but they're there in part by the Starbucks, admittedly. But I think one of the causal factors is also, excuse me, but we've all been taught by the same professors, the same ideas for decades from the same universities. And maybe that's actually a source of bland sameness as well. Don't know. It's my theory. And I have a chip on my shoulder. I went to the University of Colorado, a state school. Not a lot of people in the investment biz for my alma mater. And in fact, the scion of the firm that I used to work for said, never hire anybody who went to school west of the Mississippi River. So when I had my first Lipper number 1 certificate, I was at a board dinner and I poked him in the ribs and he said, he actually poked me in the ribs. Congratulations on all your success. It's great. And I said, not bad for a kid who went to school west of the Mississippi.
University of Illinois. So I am east of the Mississippi, but not by much. There is, I'm not going to name names. I was so flattered. Oh, the ego was taking off after I got a comment. One of the investment managers that my organization knows very well from over the years, who have an exemplary track record at active management. They've really added value for their clients. We were talking over a cocktail once. He was the CIO, but really didn't want to be. He just wanted to be a PM because he liked the work. It wasn't about the people stuff. And then he looked at me, he goes, oh, Michael, you could be our CIO in a heartbeat. You would be wonderful. And I'm like, really? You think so? I actually didn't believe him. It was the first cocktail. We weren't several cocktails in, I swear. Amazingly flattered. But this goes to this topic a little bit. Different qualifications for different roles. Because of my learnings and because of my interests, maybe I belong in a different chair. How can we rant that just because you have a CFA as an example, you ought to be an analyst? Just because you're a CFP, you ought to be a planner? No, we each bring our own strengths and weaknesses to our own learned credentials. How are we leveraging the strengths?
You and I have talked about this before.
This is my rant. I think a lot of people are in the wrong seats.
He and I have talked about this before. And one of the things we said to a client, trying to remember who, I think it was last year, we said, is there any reason why your best analyst can't make more than your worst PM?
Oh, that's a good question that nobody will ever accept.
They won't accept it because they think of PM as a role that's bigger. And to our point, PM is a different skill set. I knew plenty of guys who were good research analysts, made poor PMs or middling research analysts, but through whatever means they were PMs. They were great managers of people, great developers of talent. They were perfect for a PM role. And
the Peter Principle lives big in the investment management industry. Good analysts are promoted to be PMs. Managing
and research analysts will say and accept that promotion because they know that's the only way they'll make more money. That they'll know it's the only way they'll make more pay, even if they don't want to say yes.
Yeah, you know, when you get a great research analyst, appreciate that. Pay them at the same level as your PM. Different skill sets, people. They are different skill sets. Managing a team of people versus managing securities that don't know who you are and don't care anything about you and don't have any emotions. Different skill sets, people.
Totally different. Like I used to say, the difference between a research analyst and a portfolio manager is one aims the gun, the other one pulls the trigger. The emotional burden is on the PM, and not everybody's cut out for that. Not everybody's cut out for that. I worked with a guy, unfortunately, he was a better than average, probably research analyst in my opinion, and promoted to PM. Bad. He ended up leaving the business because he was humiliated, and he would get paralysis at the time to pull the trigger. And the only difference was he just didn't have the emotional makeup to be able to do that. He just thought of everything that could go wrong.
But it was the only way he could make more money.
Yeah.
Is that backwards? We should pay people and pay them well if they're really, really talented. Why not pay them for their genius? We don't want to promote them to their maximum level of incompetence. Also, that is the definition of the Peter Principle.
All right, audience, any other people? I see heads nodding. There's some comments rolling in. Thank you for those of you who have voiced them. Anybody else have a rant, one that's on their mind?
Do you feel ranty? Oh, for fans of, say it, what's the movie?
I don't know. What is the movie?
Oh, come on. Do I make you randy? No. Do you feel ranty?
I don't know what movie you're riffing on, my friend.
Oh my God.
Well, say it. You're torturing me.
I'll give you a clue. Dr. Evil.
Oh, yes, of course. Austin Powers.
Austin Powers. Do I make you randy?
Oh, yes, indeed.
No. Do you feel ranty? Come on, bring it on, folks. Our 1 year anniversary episode rants
and
about
the first
the
impression.
industry.
And the first impression.
And the first.
I'm not ranting about that.
No, I'm loving this. So somebody has to bring a rant because right now I'm feeling very positive.
It's less of a particular rant and more, I think, what you guys were alluding to, which is the desires to always continue with financial speak. You know, as I tell audiences, our industry tends to throw words out to make ourselves sound much smarter than we actually are. And that's the part that drives me absolutely crazy, is when you're listening to or reading about speakers or you're reading through certain things, it's like you're just trying to bamboozle the audience in terms of having knowledge that you really don't have. That in itself, again, nothing in particular, just drives me absolutely batty.
Ed, do you have a particular like set of words that especially annoy you?
Oh, do you have a phrase or a statement that you
Well,
hate?
you know, diversification, again, it's just you listen to the talking heads, right? It's the same thing over and over and over again. It's just the edicts of the industry in terms of, you know, take the 5 top most used words in the industry and just make people create another lexicon. I mean, it just drives me nuts.
Yeah.
Ed, thank you for that. One of the articles I've written in recent times. No. Strike that. Flawed memory. My last book. I went through my last book and purposefully struck any big words that I noticed that I could find that were in there and restated the best I could as simply as I could. I purposefully tried to get rid of jargon and fancy words in my last book. People can grade me on how I did. That's a different topic. But that was my last proof and editing step for that book.
I think it is a problem for the industry. So many of our concepts are very simple. In Intuitive Investor, my first book, at one point I say, look, you're about to be introduced to new terms. And the reason I introduce new terms is people haven't written about intuition and investing context as thoroughly as I'm trying to do. I said, but never lose sight of the fact that our industry can be summarized in 4 words: buy low, sell high. Or if you're shorter, sell high, buy low. But let's not complicate things.
Oh, there's an easier, those 4 words, there's an easier 4 words. I had to count for a second. You know what's better than buy low, sell high? Because it's really, really difficult. Let your winners run.
Dum, dum, dum.
Easier to execute because you don't have to do anything.
True that. All right. Any additional rants? James, and by the way, hello, James. We didn't say hi to you. Stephen, hello. That's not us calling on you, just acknowledging that you're there on the 1-year anniversary podcast. If you have a rant, state it.
Come on, let your inner curmudgeon out. You know, if you're in the investment industry, you know you have this inside of you. Let it free. Because if not, mine's going to continue to speak.
Beware the Falk.
Oh, I got a funny story about that. You know, some of you know, back in my younger days, I was a baseball player. And I was a baseball pitcher specifically. Where I'm at a game, I'm on the mound, and my left fielder and other outfielders were yelling in, "Let's go Falk," my last name. And at one point, one of the umpires that were in the infield ran out to the outfield to say, "Hey, there are kids here watching this game. Would you stop with the F word?" And he goes, "That's his name. His name is Falk. And when you yell it loud, it sounds like something else."
All right. So my next rant, since our audience is either enjoying us or whatever.
We don't know what you're doing.
Yeah, exactly. Today. I won't put words in your mouth. And ironic, because the rant I'm about to have, our industry is so bloody arrogant. There's such an overwhelming lack of humility. Can we please just stop? I'm sorry. Like, no rock stars. Like, can we all just humbly recognize that people have invested their hopes and their dreams and their aspirations with us, and respect how powerful that is, and humbly try our freaking best to do what they need us to do? Oh my God, I get so exhausted by it. And it's omnipresent. In my opinion, it is getting more humble. Because the returns have not been
there. And their fees are getting cut by clients who say, "We're not going to pay you that anymore. If you want our business, this is what we'll pay."
But it's still there. And it is actually, I think of all the rants I've stated, other than the style box today, that's the one that hurts me personally the most. It almost brings me to tears. I'm just like apoplectic. Stop it. Even if you were the Warren Buffett, be humble. Stop it. It's so annoying. Anyway, that was my next rant. Sorry. Deep breath. Any others? And if not, we can adjourn as well.
Oh, no.
Oh, Trey's
Oh,
Trey's coming.
Oh, there's
The freight tray is coming down the tracks.
bring
I
it,
just wanna-
bring it.
I want to tack on to what you just said. It's also that there's a lack of humility, but also the expectation that we can never be wrong. Like every decision has to be perfect. The batting average has to be 1,000. Therefore, we can never admit we're wrong either. So
Yeah.
I think it's a vicious cycle in there.
Yeah, you're totally right. It's true, and it creates a strange incentive because you want to be honest with your clients because they need to know because they're ultimately the decision maker. It's their capital after all. But you're right.
They won't be honest for fear of not getting hired. You know, if you tell somebody, hey, you know what, I'm right 52% of the time. Do you really think they're going to give you their money?
Maybe you just say in baseball, Ted Williams, he was 40. 400.
Yeah, but people don't understand statistics.
Well,
Yeah,
you just
400.
said 52%. I didn't put the statistic into this.
Well, they
discussion.
understand 52% is barely better than a coin toss.
Yeah, well, true that. Yeah, Trey, I think you're right. That is an annoyance. And all right, since I just defended the client, can I just rant a little bit? Clients, can we have a little moral fortitude? Can we hold on? Every freaking advisor says it. Every finance book, says it. Hold on. Stop chasing returns. God damn it. Anyway, there, rant against clients.
Wow. Throwing clients under the bus. Some clients need to be under the bus. People in the business are not right 100% of the time, as Trey just pointed out. It's not possible. So when you hold people that you hire to a inappropriate standard, they are going to fail. So then you're going to leave them and you're going to look for somebody else that's going to promise you, and then you're going to leave them. And that vicious cycle will basically crack your nest egg. Be very careful here. So yes, clients can be part of the problem. I said it. Oh, this is recorded. Oh, no. Yeah. How about we begin with a little literacy? What do you understand? What don't you understand? And we help the clients understand more. And if we do that, we probably will be able to do better work for them. Back to my Prozac topic before. When I asked the audience, if you took a Prozac before your clients came, do you think you could do a better job? And there were a lot of people who were nodding. Maybe it's us that need to chill to better help the client. Maybe it's the clients who need to have lower expectations to actually have a higher result. There's a strange oxymoron.
I know the great irony, though, going back to the clients who are short term and swap out of their funds are unlikely to listen to a podcast into the 47th minute. so probably there'll probably be no offense. They're already on to like a cat video or something by now.
What else we have? People writing things in, or somebody who wants to share another comment.
Buy and hope, people stealing other people's ideas. Oh yeah, without any credit. Okay. True story. Somebody from a well-known investment manager from the Midwest was kind of an idea stalker. She would call me up. I met her at a conference. We had a nice lunch together, sharing, spitballing about the current landscape for investments. We exchanged business cards. She kept calling me, and she would bald face say, "What are the best ideas you guys are investing in right now?" What? Do your own research. What? An utterly bizarre and true story. And she, for 2 years, would do this. It was really strange. So I started feeding her ideas I wanted her to invest in, so her returns were worse. I hope she bought these damn things. Anyway, that's a rant too. It's just that's incomprehensible to me that somebody would do that.
Oh, well, Jason, he shat on the style box earlier. So let me tell my own story about this. Many years ago, I had a client when I was doing private wealth work and tried to build a very nice portfolio based upon him and his family's needs. Well, what happened is he discovered this thing called the library, and he started going to the library. And you know what this library had? Morningstar mutual funds. And he started reading every conversation I had with him after that. Michael, why don't I own this fund or that fund? Mind you, every single fund he brought me, why not, were 5 stars and were large growth. The year was 1999. Yes, I still remember this story because I kept working to dissuade him from asking me to invest and change a diversified portfolio to everything in large growth. Finally, I said to him, I said, listen, this is your money. You have every right to do what you wish with your money. I will not do this for you. So, do you want to stay with me, or do you want to take your money back, fire me, and invest on your own? He took his money back. If he followed what he did, within 1 to 2 years, he lost 50% of his assets based upon what he continually was bringing to me.
So one of the cooler, I have several statistics that I've encountered in my almost 30 years in our business. One of the more fascinating ones, just from a couple of years ago, is that we've all heard the stat of the average mutual fund investor doesn't earn the returns of the funds they invest in. But Spiva, I think it was Spiva, however they pronounce it. Spiva announced a couple of years back that that's also true in those who invest in index ETFs and index mutual funds.
How do you underperform investing in an index fund? Oh, that's because you're buying and selling versus buying and letting it sit.
It's because you run away from loss and you chase return. And anyway, the one we have not mentioned yet so far, and I'm shocked because this usually features in our cocktail conversations pretty early on. Industry, you have the wrong definition of risk.
Oh, yes. Oh, yes. Oh, yeah. Ed wants to speak.
Ed, please.
Ed.
No, he's leaving.
Go. Congrats. Yeah, I've got to go. I got to go to a client visit. Congrats, gents. Nice work. Talk soon.
Thank you so much, Ed.
Thanks, Ed. Risk is a 4-letter word. Yes. But you know what risk is? Risk is simply falling short of the goal. Everything else is mathematical masturbation. There it is. I said it. I brought in the extra M word. Risk is simply a client, the risk of falling short of their goal. Are we helping them get to where they want to go? Helping them to stay the course? Stop with these statistical risk measures.
VAR. Oh, wait, that's more jargon.
If you remember nothing from this 1-year anniversary podcast, Michael spoke the words mathematical masturbation.
From a guy who's very quanty and mathy. So you would know.
Hey, it's not a shame if you like math. It's how you use it, how you talk about it.
Of course, I understand. So I think on that note, we have to adjourn, right? I've embarrassed myself hopelessly.
Or me.
So anyway, thank you all for joining us. Thank you for seeing us through for our 1-year anniversary. As per usual, we do it every other week. We will be back on the 8th of July. Here in the States, happy Independence Day. Those of you in Europe, or is anybody on from France?
Bastille Day.
Bastille Day is coming up.
It is.
Happy Bastille Day, but we'll see you before Bastille Day. Anyway, thanks everyone.
Bye-bye.
Bye.
Congrats, guys. See you.
Thank you.
Thank you.